Hey everyone, welcome to my channel. In this video, we're going to go through my entire Wealthsimple stock portfolio. We're going to start on the Canadian side, then we're going to go into the USD side of my portfolio. Overall, my portfolio is at about 195,000 bucks. It's been flat over the last few weeks for those of you who watch my shorts and other videos. So hopefully we can overcome that, get over the $200,000 mark soon. But before jumping into it, if you would just take a minute to give this video a big thumbs up, it really does help a lot with the YouTube algorithm for a smaller channel like myself. So if at any time throughout the video you're liking the content you're seeing or appreciate the time I'm putting into this, be sure to give the video a like. Okay, overall, we're going to start on the Canadian side. You'll see in the last month here, I've actually dropped about 3,500 bucks as lots of REITs along with lots of my banks have been trending down. But over the longer term, go past 3 months, I'm up about 1,000 bucks. Over the last year, up almost $5,000. And then overall here, up about $7,500 on the Canadian side of my portfolio. And for those of you who are interested, I think I started this account late 2020. So yeah, about mid-October 2020, let's call it. So I've had it for about 2.5 years now. So given the volatility in the market over that time, happy to be up $7,500. You'll see by some of the stocks that I own that I don't own lots of stocks that fly up and down, um, 50, 60, 70, 80%. Not too many speculative plays here. So you'll understand why I didn't really have a huge drop off as interest rates skyrocketed. But let's just go through this video here and go through the stocks that I'm currently holding and how they're doing. So you'll see we're starting off with some of my weaker performers here. Allied Property REIT. This stock here is down over 20%. This is a office REIT in Canada with a yield over 7.5% here. They do about $2.20 of funds from operations. So this one's trading at about 10 times earnings. My overall thoughts on this stock, down 40% in the last year, it's just gotten crushed, is for the flagship assets that they own and the earnings power they've considered to crank out, their earnings haven't really gone down. It's just the multiple contraction. I think at 10 times earnings, despite the headwinds in the office space, it's a good valuation for these assets. They also have a lot of other real estate that isn't necessarily an office. I think 10% of their business is storefront, like first level retail and downtown cores, which is really valuable. They also have some other flagship assets, lots of parking assets and downtown core, stuff like that. So I like this stock at 10 times earnings. I'm trying not to make it a huge position, but it's one that I'm comfortable with. I'm not getting scared away by the office exposure. In the grand scheme of my overall portfolio, it's not a big position, so I'm willing to take that risk. A&W Royalty Corp. This is one that I've been building out more and more, trying to get to 500 shares, so I'm almost there. But they pretty much get a 4% royalty, I believe, on every dollar spent at A&W restaurants across Canada. So very capital asset light, just cash flow pumping into the entity, pumping out to me, paying me a nice monthly dividend, pays over a 5% annual yield. Going on to Scotiabank here, I think Canadian banks are generally cheap here. They've had a great run over the last 30 or 40 years, showed that they can get through everything, very resilient, essentially an oligopoly, will likely be backed by the government if anything ever happens. But this one here is paying over a 6% dividend yield, even though Scotiabank has increased their dividend almost every year over the last 50 years. So over time, you're more than likely getting in at a 6.2% yield on cost, but it'll just compound and expand from there, which I really like about the name. You'll see over the last year here, down over 20%. Long term, I wish I had an all-time clicker here, but long term, anyone who's bought in Scotiabank over a long period of time or held for a long time has done very well, along with any of the other big Canadian banks. So this, in my opinion, is a good opportunity to build out this position a bit more. I'd buy Scotiabank stock right here at these levels. CapREIT, a bit more of a safe REIT in my mind. They do residential rentals across Canada. This one trades at a bit of a more rich multiple, about 3% dividend yield. I think it's trading at about 20 times funds from operations, so more expensive, about double the value that Allied is. But with that being said, you're getting a much safer revenue stream of residential rents versus office rents here. So I like this one for the safety, still getting some exposure to the Canadian housing market here, and getting that monthly cash flow from it, which you wouldn't get if you were to buy an apartment in Toronto or a big Canadian city. Cash, this is mostly just where I park lots of my available cash in the account. So I have about $12,500 in here. I used to have closer to 20,000. I've been taking money out of this holding and putting it into investments as the market's trended down in my Canadian account. But you can kind of see here, it's just a great high interest savings account. Goes up to about 5, 15, 50, 15, 15, 20 a share, depending on what interest rates are. Then you get it paid out as a dividend, and the stock goes back for the next month. So overall, I think this one's paying out about a 5% annual yield, which is pretty great to have for a stock or a high interest savings account that you can cash out at any time and be flexible with. So I've enjoyed holding it. CN Rail, one of my favorite stocks of all time. We'll continue buying it at these levels as well. You can kind of see just long term, any 5-year chart I find of CN Rail, it's always up and to the right. In addition to the dividend that they pay, that's about 2% and growing every single year. So that's another one that I'd like, looking to expand on that position for the long run as well. It's going through some quickly here. Canadian Utilities. Lots of these are stocks I've held for a very long time in this account and in other accounts and registered accounts. Canadian Utilities is one of the longest paying Canadian dividend growth stocks in Canada, but they do have a pretty high starting yield, close to 5%. So they've just been increasing their yield like 1-2%, pretty much a penny a year the last little bit. Still nice to get that little raise, but you're really buying it for its starting yield here, close to 5%. Diversified Royalty Corp is one that I like as well. Pays about an 8% dividend. Owns the trademark rights for Mr. Lube, Sudden Realty Group, Oxford Learning Centers, a bunch of miscellaneous other businesses. But the biggest one is Mr. Lube. And every time money gets spent there, similar to A&W Royalty Corp, you get a portion of it from owning the trademark, and then it gets paid out to you in a monthly dividend. First Capital, similar to some of the other retail REITs I own, just owns flagship retail across Canada. Fortis is a regulated utility company, so lots of their revenues are flat or preset rather, with inflation adjusted increases every year, but they're investing a lot in growth as well. This one is similar to Canadian Utility. They do increase their dividend every year. I think they actually target a higher dividend increase, 5-6%, but they have a bit of a lower starting yield at about 4%. One thing that I do have across my Canadian portfolio is covered call ETFs. So these assets hold stock and then write covered calls on them within the ETF. It's a bit of a higher management fee for them, but the premiums you get on the covered call really enhances the income. So you'll see here, this is a Harvest Global Utilities covered call ETF, and I'm getting an 8% dividend. The stock's been down about 2% over the last year, but I've made that 8% from the dividend. Another couple that I have that are covered call ETFs down here are ZWB, which is a covered call banking ETF. Banking's gotten crushed in Canada, so down 13%, but I have at least got about 8% of it back from the dividend. ZWC is a covered call ETF just on total Canadian market dividend stocks, another 7.4% there. This one down about that much, so haven't made any money there, but it's an interesting strategy to get monthly cash flow into your portfolio on a monthly basis. Continuing to go down here, QSR, this has been one of the biggest winners in my Canadian account, up over 30%, over $2,700. So 1/3 of all my gain in my Canadian account has been this one stock. They own Tim Hortons, Popeyes, Burger King, as well as Firehouse Subs, and they're primarily a franchise, a franchisor. So they'll franchise these brands around the world for small business owners to own their locations, and then they get fee and royalty revenue back. As you can tell, I really like the royalty model on stocks. It's really asset light. not as much volatility in the earnings, not as subjected to inflationary costs, wages going up, stuff like that. You're really just getting a top line haircut on the business. RioCan, probably my favorite retail REIT, similar to First Capital that I talked about earlier. This stock, I just did a separate video on, but they are going to deliver about $1.80 in funds from operations this year. So trading about 11 times earnings here, down 7.5% as interest rates have gone up. Sentiments about recessions and stuff like that have fallen in, but you're getting about a 5% annual dividend yield on this one, which is great monthly cash flow for really solid assets. So it's a really big position across all my accounts collectively. So it's not one that I've been adding, but I don't think it's at a bad value at about 11 and a half times funds from operations. TD is my favorite bank. I think it's the most solid bank that I own in Canada. I like how they're mostly a commercial bank, so their earnings aren't as volatile as like an RBC with a huge investment banking and capital markets division. And that's why it's one of my biggest positions, not necessarily in this account, but across accounts. Now they're currently trading at a 9.5 times earnings, almost a 5% dividend. So this is one that I would buy and would add to with available capital. And then lastly, ZDI is an international dividend ETF. This stock here has really ramped up. It went down behind everything that's going on in Eastern Europe over the last couple of years, but has really shrugged that aside, up over 11% on the year. Also, you get a nice 4% dividend, gets paid monthly at these levels. But this company, or this ETF rather, holds a lot of European companies. Also gets some exposure to Japan and Australia, which I really like. Lots of my holdings are North American based, so I really don't get too much exposure out there, which is why I've really liked holding this company and adding it to my portfolio. I have about $10,000 in this account and like getting my monthly dividend from this international dividend ETF. For Canadian investors who are looking for diversification geographically, this could be a great option if you're also desiring cash flow. Okay, so overall, that's the Canadian side of my portfolio. It's really been over the last month what's dragged my overall portfolio down behind the REITs and the banks. But long term, really comfortable with those investments. Happy to double down on them even. So not too phased. Going over to my US investments here, starting with overall up about 17%. And this account started just about a year and a bit ago when they let us open up USD accounts on Wealthsimple Trade. So February 2022. So really good results over the last year and a half, let's call it. Going into the last year alone, just up even more, 21%. Last 3 months up 11%. And then the last month, at least I'm not down like in the Canadian account, but it's pretty flat, up about 1%. So going through the portfolio here, I have Google. Google's been on a wild ride, but Google's a stock that long-term I like having across my portfolios. Think it's a great business, great stock. With tech, it's ever-changing, ever-evolving, so have to keep a close eye on these ones to make sure I'm comfortable with how they're positioned and what their mode is. But overall, I think they're still in a really small position. Love that they own YouTube. Think that's a great asset. That's really hard to compete with and win. Share firm. I know some short-term things like or short form video things like TikTok are taken off, but ultimately I think YouTube's like the king of long form peer-to-peer education, entertainment, stuff like that. Coca-Cola I think is a great just long-term hold. Trying to get this one up to 100 shares. Global company, love the global scale of the company, really good unit economics as well, and they're dividend growth king. So over time, hoping they compound their dividend that I'm getting. Similar story for McDonald's here, up 25% on my McDonald's position, even though it's really small. But just while the company is trading way higher than I'd feel comfortable adding in a big way to, about 28 times earnings, it's one that I just love the business overall. Once again, that royalty model also owns lots of their real estate. Very powerful brand. So love holding the company, but not buying any more here. Meta, I'm up over 150% in this account. I do own Meta across multiple accounts, so I wouldn't say I'm up 100% overall, but it's been nice to at least get that big jump in this account, up about $1,800 since I added to it in this account. Given just I felt like when it was at like 80, 90, $100, when I strip out Reality Labs, the company was trading for like 7 times earnings if I take out the cash too. Thought it was way too cheap. Really think their social media side of their business is extremely powerful, has a lot of runway on monetization. Hate the Reality Lab side, but it did give me the buying opportunity I got on these shares specifically, so maybe I shouldn't be so harsh on them. Microsoft, great business. Would love to make it an even bigger position across my accounts, but it's really run up lately, looking just in the last 3 months with everything around AI and stuff. For a multi-trillion-dollar company to run 30%, that's a huge, huge run. So not one that I've been adding to, but love that I have the position I have across accounts. Realty Income is another one similar to Coca-Cola where I've just recently started buying into it. Down here at about $60 is around where my average is. My average price is $61.50. Once again, trying to get over 100 shares in this one. I like that it's a monthly dividend payer. I like how geographically diversified they are across the US as well. Don't think I'd make it into a huge position, but wouldn't be afraid to get to 150, 200 shares in Realty Income. P&G, very, sorry about that, very similar thoughts to Coca-Cola, McDonald's, etc. in terms of the reason I hold it. I think they're great businesses, great brands, but not cheaply valued at these levels, so not really adding to it in this account. AT&T, maybe one of my more controversial picks, and it has not worked out if you could look at the total return. But I just think this company is going to make around $16 billion in free cash flow. The company trades at a valuation of $115 billion. So they're trading at 7.5 times their free cash flow. They pay 7% out to me as a shareholder. They use the rest of that money to pay down debt, hopefully, or invest in other things that are going to grow the business. I don't think it's, the best business of all time that I hold, but I think the valuation's so cheap that I think the net present value of the company is higher than 16, given they're going to be getting like $2.50 of earnings just this year alone. So I don't know. I don't see the demise coming as quickly as others, and I think there's still some value to squeeze out of that stock. Visa is probably one of my favorite stocks besides CN Rail. I'm trying to make it a bigger part of my portfolio. It's essentially just like a royalty on the global economy, and they also have the tailwind of cash to card payments swapping over, which we've seen in many countries around the world is still evolving and still a lot of runway left there. So I think this is a fantastic business. The biggest risk is just like regulatory risk. But overall, would love to buy more of it. They're going to make about $8 of EPS, so trading here at about 28 times current year. But they've compounded revenue, earnings, double digits for a long time and with no sign of slowing down. So I think 28 times this year's earnings will probably turn into 20 times 2025 earnings or something like that. So I think this company will continue to go up as their earnings expand and as their revenues expand. Big company, almost $500 billion, pays a small dividend, but once again grows at double digits. So hopefully 10, 20 years from now, the yield on cost will be pretty good. And I'm just kind of screwing around with this one, but I bought 2 shares of WWE just here today as it dipped out under $100. I'm really interested in what that new company paired with the UFC will turn into from a valuation standpoint. I think UFC was very undervalued as part of Endeavor, so not going to make a big position out of this. If it goes up over $100, I'll probably just trade it out and make my couple percent. But just kind of fooling around on this one. Like the business they're merging with. Valuation admittedly is high, so if it crashes from here, I'll lose a couple dollars on my couple shares. But would more than happily build a position at a better valuation in the combined company. So hate to end it on my only speculative buy that I have in here, but I hope you guys enjoy me going through my portfolio here. Please let me know your thoughts on any of these stocks. Would love to hear your bull cases, your bear cases, if you own any of these stocks as well. Hoping that my portfolio, especially on the Canadian side, will turn around. I'll surpass that 200,000 mark in my Wealthsimple account. But wanted to thank you guys, especially if you watch to the very end. Once again, if you like this video, be sure to give the video a thumbs up. Really helps the channel, and I'll see you guys in the next one.